Hey everybody, Chuck Barone. It is Tuesday, July the 18th, 2023. Another day of madness. I tell you guys, it's just the wackiest world. I gotta tell you, man, when nothing is just predictable anymore, it's like every day is a big surprise. Amazing to me. I thought I kind of knew my way around a little bit. Pretty fair spotting trends, but whew, man. Okay, so we got some news today, making the markets go wild. But anyway, before we get all into all this, let me, of course, welcome everybody to the show. Thank you guys for your support. You know we love you guys, appreciate you. All right, so markets today. We knew we were going to get some data. We get retail sales. We get some manufacturing data. Neither report really very good. But the market's feeling pretty happy right now. Dow Jones really rocking and rolling again. Another day of big gains for the Dow. Stock market's on their way up. It looks like, now this talk of soft landing starting to be more and more and more, dominating this idea that we're going to get past this inflation. We're going to get everything back to normal, and we're going to do it without a recession. I got to admit, I'm not quite convinced of that, but we're going to watch it. We'll see. So, markets today feeling pretty optimistic. Bank earnings coming in. Actually, a lot of earnings coming in, but bank earnings leading the parade today. Most earnings beating expectations again. Dow jumping 366 points, 34,951 on the Dow. A great number. Dow rocking. The S&P, the broader market, up 32 points, 4550 on the S&P 500. I was reading today they were saying JP Morgan, or no, it was a Credit Suisse, raising their estimate for 4,700 at the end of the year for the S&P. The NASDAQ up today as well, 108 points, 14,353 on the NASDAQ. So, these markets, these indexes, really on a roll right now. Markets feeling optimistic, and I guess according to the numbers we get, have reason to be. So, stocks up. Bank earnings today, I guess JP Morgan and a couple others leading the way. Morgan Stanley had a very good quarter. These quarterlies, though, I never been a big believer in that kind of concept where everything is every 3 months. Makes it very difficult for corporations to really plan long-term stuff. But big quarter. Bond market today, weird day in the bond market, kind of a quiet day for a change, the way the bond market's supposed to be. The 10-year sitting basically unchanged today, 3.79% on the 10-year. The 2-year climbs 2 basis points, so not much of a move in the bonds today. 4.75% on the 2-year. Bonds having a nice quiet day, the way we like it. It looks like, this inversion here, we've been waiting for a long time for this inversion to lead us to what it foretells, which is a recession. Still no sign of it. Interesting. The dollar today up just fractionally, 99.94 on the index. Looking to get back above 100. I'm figuring it's probably going to do that soon, depending on how the Fed behaves. I think, like I was saying yesterday, I think this is going to be a kind of a quiet week in the markets. Everybody now waiting on the Federal Reserve next week in their open market committee meeting. I think that these markets are kind of behaving exactly as we expect them to. Metals today, gold and silver having a good day. Gold up $23, sitting at $1,977.50 for an ounce of gold. A good number for gold. Silver jumps 26 cents, breaking 25. $25.02 for an ounce of silver. So gold and silver looking strong here, guys. And as this dollar comes down, these numbers are going to continue to climb. Happy to see it for all the people out there watching who hold gold and silver. Oil today up $1.56 per barrel for West Texas Intermediate, closing at $75.71, just outside our trough. It's between 70 and 75. Would not be a surprise to me, even in the slightest bit, if it comes back down under 75, finishes under 75 this week. Bitcoin today down small, down $207, 29,735 on Bitcoin. Still holding its own, man. Bitcoin is doing just fine. All right, so news we need today, news you guys need to hear. We knew retail sales were coming. That was going to be the big number the Fed was going to be looking at this week. Consumers have been spending money pretty regularly. Consumer prices and consumer retail, the pressure's been on prices because consumers shrugging off the higher prices and shrugging off the inflation and continue to spend money. Well, things quieting down a little bit in June. Retail sales for June coming in at plus 0.2% for the month, down from 0.3% mid-May. Way less. They expected 0.5% gain. That's pretty fast. That's 6% a year pace, man. That's pretty fast. Disappointing the market, but not really disappointing the market, I guess. Surprising the market, but coming in as it did to the downside. Consumers spending a little less, still spending, but the pace slowing. They believe that's good for inflation as well. Not as much demand for products and services tends to bring the prices for those products and services down, right? So this is a decent happening where consumers are still spending, just not at the same pace they were, late last year and earlier this year, right? U.S. corporate defaults. I was reading this as an interesting article today. They were saying U.S. corporate defaults are already blowing away the entire year for 2022. Already so far this year in 23, we've had 55 corporate defaults. Not good, right? Last year for the entire year, the total for corporate default was 36. I'm sure a lot of this has to do with commercial real estate. Default rates have risen now to 3.8% from 3.6. And Moody, which was the source of a lot of this data, their analysts say we're going to have a 4.7% default rate by the end of the year, with the peak coming next year in March at 5.1%. So I guess this corporate situation foreshadowing the public one, because everybody's loaded up with debt, starting at the top with the government, onto corporate America, then onto each consumer. People not learning lessons, forgetting long lessons about debt. So now, time to pay the piper, man. No free lunches in this country, right? So corporate and commercial real estate at a crossroads right now, man. I think that if U.S. corporations can just walk away from their obligations, that's certainly going to lead the public to believe it's okay for them to do that as well. So this tends to be something that kind of spirals and doesn't end well for us, right? So fascinating stuff here. I think that they did not break down these defaults, like, was it a bond default? Was it a default on, mortgage? How was it structured? What was the debt, related to? Was the debt secured or not? So that was, the article didn't have a lot of the details I was hoping to have in it, but the idea that U.S. corporate America is defaulting on debts, well, that's going to put pressure on rates, because corporate debt is a big part of the bond market in this country. And if there's going to be a 5.1% default rate, I'm guessing the prices of bonds are going to go down and the rates are going to have to go up for those. Let's see. Last today, I was reading this article. This was really interesting. We've talked about it before. We've been predicting it and looking at these markets. I got flamed on several times for saying that things aren't as bad as everybody maybe wants to believe they are. This phantom recession we were supposed to have and did not get. You get 2 consecutive quarters of negative GDP. You have an inverted yield curve. You got every sign in the world pointing to recession. Never happened. Why? What the heck? So UBS putting this out today, I thought this was really interesting. They had said 10 reasons why we haven't had this long forecast recession. They said that, number one, monetary policy is not too tight. And when I say monetary policy, I'm talking about the amount of cash in circulation. They said the Fed balance sheet's still massively bloated. And they said the inflation index treasuries still have super low yields. So that big part of it. Number two, government spending. Government spending on the rise. Of course, that contributes to jobs and keeps the economy going. Number three, they said strong consumer saving from the stimulus. Those checks, big tax returns. So consumers had plenty of money stashed they couldn't spend during the pandemic. Those cushions sustaining them through this inflation, right? They said that debt levels, while high, are much less than they were before the big crash in 2008. I thought that was interesting because I know debt levels right now are sitting very, very high for most consumers. It said credit conditions are still accommodative despite recent tightening where they've kind of made standards a little bit more difficult to get and obtain credit. Still loose, credit available. They said that economic data is getting stable again, where it's not all over the place. We're not dealing with bottlenecks. We're not dealing with so much pandemic-related uncertainty. They said we have a very strong labor market. Hiring's still high. They said the recession itself confined basically to sectors that are interest rate sensitive. Real estate. They talked about residential and commercial. Talked about manufacturing and the stress that puts on manufacturers as far as buying new equipment, expanding the facilities. And I know it was said too, as I read that article, it said in the U.S., manufacturing now is only 11% of our economy. That's disappointing. Anyway, strong, strong services, growth in services, people still spending money for services, restaurants, rocking and rolling, other professional services. And they said the economy, because we're not in a manufacturing economy so much anymore, is much less cyclical than it used to be back in the day, where once the cycle starts, if you're a manufacturer and people aren't spending money on, let's say durable goods, refrigerators in your Westinghouse, well, the cycle, that's what they dealt with. Not so much anymore because manufacturing is such a small part of our economy. So I thought those were interesting reasons, pretty compelling argument there on why this recession hasn't hit and the things to be looking for to signal that maybe we're not out of the woods yet. It's hard for me to believe that we have this perfect landing here. It really, really is. We had a very difficult year. Inflation got crazy. Hard for me to believe that we could put it all to sleep in a year. After watching the way it went down in my youth as a young kid, watching the way things were in the 70s into the 80s, this is nothing at all like it. Crazy. Anyway, guys, that's it for the day. Not a lot happening. We'll be back tomorrow. Looking forward to the unemployment numbers on Thursday. We'll bring you guys the news you need. In the meantime, the stuff we've been telling you all along is the mainline stuff. Save your money, targeting 10% of your income, invest your money conservatively, don't add on new debt, spend your money judiciously, spend the money you have to spend, but be careful of impulse stuff, don't waste money. If you have existing debt, do what you can to pay that debt down. And even if it's a little at a time, $10, just pay a little bit extra. Anyway, guys, that's it for the day. Tomorrow's another one. We appreciate your support. We'll be here to bring you the news you need. Until tomorrow, then, take care. Thanks.